And to help us make sense of all of this, we have Francis Tan, Chief Strategist at Asia and Suez Wealth Management. So, Francis, good to have you in again.
Thank you.
Just want to start off talking about VLPR. So, unchanged 3.1, 3.6, respectively. And so, was this expected?
This is expected, although I still think that there's more room for the policymakers to cut rates this year, mainly as a buffer to support them against some of the external factors that's coming mainly in the form of the US tariff against them.
Yeah, so at the same time, markets, they are weighing more stimulus, possibly being rolled out soon by China on the back of the escalating trade war with the US. I mean, we haven't really heard much, but what could it possibly do, and how does that square? How would China square that with, its shrinking interest margins at its banks, which of course then would kind of limit the scope of the kind of monetary support that it can deploy?
For China right now, I guess it has to be on two folds, the two arrows, mainly number one on the physical part, which is a lot of government expenditure, government's issuance of what we heard from the two sessions as well, the ultra-long bonds and supporting domestic consumption. We have already seen them subsidizing trade-ins for household equipments. And we do see that the most recent retail sales numbers from China, quite a big jump, more than 30% year-on-year jump in household equipment. So I guess the consumption part is still going to be supported quite strongly, aggressively by policymakers. At the end of the day, if you look at the overall C plus G, meaning the consumption plus the government expenditure, it stands at around 60% of China's GDP. So, well, against any external headwinds, I guess boosting domestic is really important. The other part will be monetary. I'm expecting more triple R cuts as well and LPR cuts into this year. But I guess more clarity needs to be seen on how the upcoming data is going to be, because first quarter China's GDP 5.4% year-on-year is quite strong enough that I don't think the PBOC want to do anything. But if we look at second quarter numbers coming up and some of the higher frequency numbers, maybe the PBOC will finally start to ease a little bit more on the monetary accelerator.
At the same time, in your investment strategy, I think your team has reduced its U.S. exposure to neutral. And so in its place, where are you looking at? And you also say that actually Japanese equity positioning has been dialed back. And so why is that?
That's true. One of the key reasons is that the Japanese exports is also quite exposed to the U.S. as well. At the end of the day, we are dialing back U.S. because we do see that the U.S. seems to be in its tariff against the world, it may be really at the expense of their economy. A lot of investors are fearful that tariff will bring amongst other things, hyperinflation into the US, especially when goods are so expensive. But I would think that it's a lot more going to be true for them to see a slower growth rate than the hyperinflation. Because at the end of the day, if you think if the next iPhone is going to be a lot more expensive, that will hinder your purchase. In fact, you will think that maybe I'll hold on to my iPhone 16 for a while more, right? And that reduction in the consumption will trickle down into, at the end of the day, a much weaker economic growth. And for that, I believe the Fed will have to cut rates even further rather than hiking rates. So that's number one. For now, we are thinking that for some of the countries that can buffer themselves against the onslaught of such tariff will be those that rely a lot more on domestic consumption. And in fact, a large part of Asia, we do see that as true. I mean, our regional countries, quite a big part are domestic consumption. So for one, we are now looking to improve our allocation to Europe. That's one. And dialing back on US. And for Asia, I'm still remaining quite optimistic on Asia right now.
I just want to look at that. So, in Asia, China stocks, I mean, is there perhaps more reason to then look at the Asian consumer stocks, which cater to local demand? So Chinese consumer names, right? And they're likely to also receive stimulus if, say, the government wants to focus on driving.
You're right. That seems to be what investors are looking at right now. Those that are not reliant too much on the foreign exports, those that are reliant a lot more on the domestic consumption. And for one, although a lot of Chinese firms do export overseas, but a lot of these companies, they are also enjoying the domestic consumption. And one of the things to highlight is that China's exposure to US final demand is only 2.8% of their nominal GDP today. It's pretty small. For Singapore, it's 8.9, by the way. So although you may be seeing that, Singapore, we are having a deficit against US, how can we be 8.9%? It's because a lot of our exports are intermediate goods that goes to China before exporting over to the US. So our overall total impact from the US final demand is actually quite high, not low, in fact.
And Francis, just a quick one. I mean, we also want to look at fixed income, specifically emerging market local currency bonds. I mean, they're starting to look more favorable now given the weaker dollar. You know, and also amid concerns that US exceptionalism may be fading, the EU seems to say that EM bonds have been removed due to excessive FX-driven volatility.
The FX volatility is pretty high right now, and EM represents a lot of countries. It can be Latin American EM, can be Asian EMs. While I'm more optimistic on Asian economies, but for a lot of EM currencies, they are usually very susceptible to currency volatility, especially when it involves the US dollar. So for now, where Trump can go on and say that we're going to do this and relax it the next day, the volatility is going to be a bit too hard for us to ascertain the total return that you can have if you have an EM asset. So for now, we will reduce that for EM assets, but EM can be very big. So do note that we have to split it and to look at different EMs as well. But for Asia, we are still quite optimistic.
All right. So Francis, unfortunately, that's all the time we have for now. Thanks for joining us.
Thank you.
Francis Tan, Chief Strategist, Asia, Indus Wealth Management. And of course, we have